Okay, hello again, everyone. We'll get going here, and as people come in, we'll get them caught up with everything. Once again, we will be sending out a recording of this meeting to everybody, and I have everything saved. So if you ever need to look back on this, you're welcome to reach out to me and get a link to that video. Today, we are going to be, we have been very lucky to get Joe with Northwest Insurance Associates and Matt with Platinum Home Mortgage to come let us know what's going on in their worlds right now. There's been a lot of changes with just the market being kind of crazy right now. There's been changes with insurance and how that's affecting what you guys are doing with your clients, and just really giving you the knowledge that when your clients come to you with questions, you can give them solid answers, or at least make sure you're directing them to the right person who can talk to them and make sure that they really know what they're doing and you're giving the best advice possible. So thank you to both of you for being on today and willing to share your guys' expertise. If you have questions throughout the presentations, we'll let both of them kind of give their updates, their information that they have for you. If you have questions that are specific to either one, please put your questions into the chat box. Maybe just throw their first name, either say to Joe or to Matt, and your question, and we'll pass those on to them and get through any questions you guys have as well. And with that, we'll get going, guys. Thanks again. I'll let you guys kind of do your introductions a little bit more, explain who you are, and let us know what info you have.
Super.
Yeah, Joe,
Thanks,
I was
Emma.
going to say, go ahead.
Oh, okay, super. Thank you, Emma. Thanks for having us on this morning. My name is Joe Angelo. I have been in the insurance industry for close to 25 years, which makes me feel very old when I say it that way. But I started Northwest Insurance Associates here in Coeur d'Alene almost 15 years ago. And we are an independent insurance agency, meaning that we work with over 30 insurance companies to find the best fit for clients when it comes to any type of insurance. What I wanted to touch on this morning, or what Emma asked me to touch on, is kind of twofold. One is a Washington specific update, which I know will impact quite a bit of your clients, as well as maybe some of you personally as well. As well as we will also touch on as a whole, both in Idaho and Washington, how the insurance industry is handling the amazingly fast-paced increase in cost of building materials and shortage of labor to put those building materials together. So I'll touch base first on the Washington piece, and Emma, just flag me down if you want me to go in a different direction or if you need any additional information. But as far as Washington goes, many of you may already be aware that the insurance commissioner, who controls and oversees and regulates every aspect of insurance in any particular state, but in Washington, effective March 22nd of this year, banned every insurance company from using credit as a factor in rating insurance. And why is that important? We get that question quite a bit. There are about 44 factors that go into what anyone pays for insurance, whether it's home insurance or auto or any of those items. The rating models are kept somewhat secret to the individual companies. They don't share them with agents like us or clients. It's sort of their secret sauce as to how they rate for insurance or determine pricing for insurance. Up until March 22nd, credit was a factor in that, and for a lot of companies, it was a major factor. They set the weighting of each one of those categories differently, and that's how they determine their price. Credit had been used by the insurance industry and is currently used in all the other states as a determining factor to basically predict the frequency of which people will turn claims in. So generally speaking, and statistically, historically, people on the lower end of the credit scale will tend to turn more claims in. So they rate that accordingly. Conversely, on the higher end of the scale, if you have a higher credit score, Historically, people with higher credit scores tend to absorb more small losses and tend to turn in less frequent or less large claims. Well, effective March 22nd, Washington State banned the use of credit scoring in all their credit scoring models. What this means to you and your clients is that if someone has a higher credit score, and higher being a relative term, I would say anything over a 600, 650 credit score is going to be adversely impacted. The insurance commissioner feels that credit scoring in insurance rating has unfairly targeted folks that have either lost jobs through COVID or have a lower insurance score. So when you're helping clients look at those new homes, especially if they're on the higher end of the scale, or if they have obviously they're in a good credit position, they will likely end up paying more for home insurance than they otherwise would have prior to March 22nd. The insurance companies are working feverishly to reinstitute the models they had in place prior to credit scoring. But in a twist of irony, the insurance commissioner also has to approve going back to the old models. So it's kind of a pickle at this point. It's thrown a lot of folks into a tailspin. So it's definitely going to be a factor moving forward, especially as you're working with clients that that are in a position that they have managed their credit well. They're unfortunately going, what we've seen from our client base, they're somewhat penalized as a result. So I would expect that there will be several class action, probably lawsuits at some point, as those results come to play and come to bear, and clients learn about their new rate without the credit score model in there. So I'm happy to answer any questions on that piece as we go forward here. But I also wanted to save some time to speak about something that impacts both Washington and Idaho, and probably other states as well, but we'll focus on that for the time being, is the rising cost of building materials and how are we correctly insuring clients for the homes they're buying, and how are we tackling that? So as a bit of a background, the insurance industry itself, when they look at insuring a home, they plug all the factors of the home itself into what they call a replacement cost calculator, which generally speaking is hosted by a third party. The most popular one is some Marshall Swift Beck. You may have heard of that before. What the insurance companies do is they have the agents plug all the information in about the home, and it generates a minimum replacement cost that they want to see the dwelling coverage set at, so that the client can completely rebuild the home. Those models, those calculators are not moving as quickly as the lumber prices or the labor shortage or the general squeeze that we're feeling in terms of rebuilding and replacement cost, especially here in North Idaho and Eastern Washington. So to account for that, historically, most insurance companies will offer an endorsement on their home products called extended dwelling coverage. Super important, somewhat bland sounding term, but super important coverage. What generally that does is that gives the client a 20 to 25% buffer above and beyond what we've set the dwelling coverage for. So if that cost calculator comes out and determines the rebuild home is $150 a square foot, we all know that's likely not enough to get it done. So with that, even with that buffer on there, that 20 to 25% buffer on there, we still may be on the low end of the scale, especially given the current environment. So what we've been doing for our clients is looking at companies that offer a higher extended dwelling coverage percentage. Some companies out there will go to 100 or 125% of what the dwelling coverage is set at. And that gives somebody a very wide berth on setting the correct amount of dwelling coverage so that we can actually replace the home. Worked on a client yesterday. The dwelling coverage came in at 350,000. we collectively with the client decided to move that to 450 just to give us a little bit of a cushion. And then we placed 100% extended dwelling coverage on there. So while it may seem like $900,000 is overkill for a home that came in between 350 and 450, with the direction and the fast pace of this current environment, that is a peace of mind, which is really what we go for in terms of wanting clients to be able to sleep at night knowing that they can fully replace their home. What I would recommend both in the Washington situation with credit and with the home situation in terms of making sure that your clients have options in order to correctly find the best rate, but also more importantly, find the correct coverage, is to have them work with an independent agent like ourselves, where not all companies are the same. So finding the right company and matching that with your client's situation is critical, especially in the current environment. So with that, I'm going to pass it back to Emma and over to Matt, or however you want to control that, Emma. And please let me know if you have any questions. And thank you for having us here.
Yeah, thank you so much. That's great information. We really appreciate it. Yeah, we'll have Matt jump on, give a little update on what's going on in the mortgage world. Once again, if you guys have questions that you think of, throw them in at the end. We can go through any questions that you have for either of them. And yeah, and if you come up with questions after the fact that you didn't think to ask during the meeting, feel free to shoot me an email, and I can reach out to both of these guys and just say, oh, by the way, can you answer this quick question? And we can always get those answers for you guys if you come up with something at any point in time. So yeah, I'll pass it over to Matt, let you do your intro and give us your update on what's going on in your world.
All right, thanks, Emma. I appreciate that. My name's Matt Richter. I'm with Platinum Home Mortgage in Coeur d'Alene. We been a branch there since 2010. We're a direct lender, so we're not a broker, but we're actually a mortgage bank, which is kind of important in today's world. And we also, I've been in the mortgage business now going on 20 years. And so love what I do, but it's an ever-changing industry, as you guys well know, with all the rule changes and things that happen constantly in this area. It's pretty crazy to keep up with. Let's talk a little bit about where things are going with rates. That's usually a question that I get asked quite a bit by real estate professionals. Rates have been obviously very, very low for a very long time, and upward. And this is probably mainly due to some of the inflation fears that are being talked about in the market. You know, the Fed did say they want to start raising the Fed funds rate in 2023. And so we're probably going to be seeing some rising rates over the next, 18 months or so. I don't think they're going to raise super fast. I think it's going to be more of a gradual type situation to kind of keep things economically still growing, but also trying to battle some inflation a little bit there. So that's kind of what I think might happen with rates. Of course, you never know what's going to happen in the world, and that could change the game instantly. So another thing that you guys might have saw here yesterday is that the director of the Federal Housing Finance Agency, FHFA, Mark Calabria, was fired by President Joe Biden after the Supreme Court ruled that it was not constitutional the way that that was structured. So that's probably going to mean there could be some more changes on the horizon, since Calabria was under the previous administration, and now we have somebody else is going to come in there and look at how Biden's administration wants to handle that kind of a thing. So right now, we don't really know what that means, but it probably means to me that the phase out of Fannie and Freddie will probably be delayed, as I think they would probably want to keep that around and try to get the door open to more people being able to buy a home going forward. So we'll see. That's an ever-changing situation, but very interesting to say the least. I know that a lot of you guys work in the higher end clientele. And so Emma had asked me to talk about maybe a little bit about jumbo loans and non-conforming financing and kind of what's going on there. Just to recap, the conforming loan limit for Kootenai County as well as Spokane County is 548,250. So any loan that is below that or at that number is going to be securitized with Fannie Mae and Freddie Mac. So once you go over that amount as a loan, then you're going to get into the non-conforming or jumbo world, where now we have to go to different institutions or aggregators that want to basically, purchase those loans and service those loans. So you're dealing with large banks, private label companies, a whole wide variety of things out there. And we have access to quite a few of those different different areas. So, which is good because they all kind of have different rules. But the thing about jumbo loans is they're a lot more forensic and a lot harder to qualify for. They have a hard cap of a debt ratio of 43%. And you can't get any streamlined type underwriting findings like you can with Fannie and Freddie. So it's a full 2 years of taxes and full assets and full pay stubs and verification of mortgages and the whole bit. So the loans are definitely more difficult to process. So they take a little bit longer because sometimes they also require extra appraisal reviews or desk reviews, especially when the loan amount starts to get over $1 million. So it just kind of depends on the particular client and what they're looking for. But the number one key in all of this is definitely they want to be pre-approved. And if they're going to be in the jumbo world, to get a solid pre-approval will make that process timeline while they're in escrow go a lot faster, because hopefully they've done a lot of the heavy lifting already. So when I'm talking to a client that wants to do a jumbo loan, I'm trying to get as much of that upfront stuff done as possible. So that way, really, hopefully we're just dealing with, appraisal and updating some things while we're in escrow. I do know there's probably some hesitancy for the clients in the jumbo world to go ahead and get pre-approved because they feel that maybe they have lots of money or they have great credit. They don't really need to worry about that. And the answer to that is really, it doesn't matter. They really still need to get pre-approved before they go shopping, unless they're going to pay cash. So there has been some expanded jumbo guidelines. It used to be pretty cut and dried, 80% financing maximum, but I do have some investors that will go 90% financing up to $1 million or $1.5 million. Interest rates are going to be higher on those types of programs, but it is possible for maybe that jumbo buyer that only wants to put 10% down. So that's good stuff. Once you start getting over $1.5 million, loan to values will get cut down to 75 or 70. Second homes also are lower loan to value. So if you have a second home buyer, they're going to have to come up with some more cash in the jumbo world. So I kind of priced out some loans this morning just to kind of give you guys an idea. Primary residence, 80% loan at $1.5 million. Rate today is about 3% for a solid buyer with high credit scores. On the 10% down stuff, rate's about 3.75. So you can see the kind of a little bit of a difference there. One other strategy that we've been implementing when you have those clients that are kind of on the edge of conforming versus non-conforming. So let's say they want to finance like 750, but the jumbo product doesn't really fit their structure, or maybe they're self-employed and we need to use a 1-year tax return finding to get them approved, is that we can do a purchase money simultaneous second mortgage. So you do your first mortgage at 548,250, you do your second mortgage for another 150, and now you're still in the Fannie Freddie world, and you're avoiding the jumbo, but you're still able to finance higher loan amounts. And so that's a strategy we've been using quite a bit because it is a little bit easier of a process, especially when they're just a little bit over that jumbo limit and they don't want to deal with that type of underwriting situation. So That's a lot of information I just spilled out there for all you guys. I probably have some questions for sure. Happy to answer them or go deeper in certain areas if anybody would like to go deep on anything else.
Awesome. Thank you. One question real quick back to Joe. Could you confirm if it's the March 22nd or June 22nd that insurance change?
You bet. Yeah, the order was issued on March 22nd. Depending on the carrier, and depending on whether it's newly written business or renewal business, the date can vary. June 19th is a date a lot of the carriers are using for new business, but renewal business can vary just depending on when an individual client's policy will renew.
Okay, perfect. And once again, if you guys have questions, put them in the chat. And if you come up with questions after the fact, I'll put a list together of any questions you guys have and kind of send it over to these guys, see if we can get answers for you. If you think of anything, I know sometimes it's after the meeting ends that you kind of think of those things. I'll give you guys a little bit of time to think if you have any questions. We do have one premier property that I wanted to show you guys that just came on the market for, let's see, are either of you guys on the call for both Scooter and Michelle? It doesn't look like you guys are on the call. If you are and I don't see you, put something in the chat so that I see you. But I'm going to share the screen real quick just to show you guys their new listing that they wanted to let you guys see. Let's see here. Okay. Oh, it just went away. I'll give it to you guys again. Also, just a shout out that if anyone has premier properties coming on, we're always willing to share them on this. Do a quick, if you're on the call, you can give a quick update of what your listing's about, what you're seeing for it. And pretty soon here, we're going to start doing in-person stuff again. So get back into it, get connected, and be part of this. So if you guys can all see my screen, this is Michelle and Scooter's new listing. It is over in Coeur d'Alene. It's on 5 acres, just shy of 5 acres, beautiful house. I'll show you some of the pictures here real quickly since they're not on the call. We'll kind of try to get through it, but looks like a really cool spot. If any of you guys have buyers, please reach out to either of them. I know they'd be happy to give you more information and tell you more about the property, but looks like a pretty special spot here. Yeah, and I believe it's listed for $1,675,000. 4-bed, I think it's a 3.5 or 3 3/4 bath. But yeah, it looks very clean, and I know they're excited to get it sold. Okay, I kind of sped through those, but I'll put a link to this property in our post meeting notes as well. There we go. So then you guys can always go back and look at that if you please. Haven't seen any questions come through so far. So once again, email me, text me, call me, anything you guys have questions on after the fact, or if you think of anything. Thank you so much, Joe and Matt, for all that information. I know that's really helpful for our agents to have when they're speaking to their clients. And we really appreciate you guys taking the time out of your morning to help us out.
Yeah, my pleasure. And I did want to say one other thing that I forgot to mention is that we are licensed to originate loans in Idaho, obviously, Washington, California, Arizona, Oregon, and Montana, all locally right here in Coeur d'Alene. So if you have clients that are looking in any of those areas, we can give them the local service right here. I think, Joe, you might mention where you also write all your policies. I know it's more than just a couple of states. So.
Yep. Yeah. And again, thanks, Matt, and thanks, Emma. Yes. Yeah. We have, again, over 30 insurance companies. We're located here in Coeur d'Alene, but we actively write business for clients in Idaho, Washington, Oregon, and California. So we're well positioned to help anybody out that you might have that either coming to the area or maybe transitioning out. So again, thank you very, very much.
And we did actually have one question come through last minute for Joe. Do you have a projection for how much more a person would pay for insurance for someone over the 600 to 650 plus credit score?
Yeah, this is a good question, and it's somewhat of a crystal ball projection. We just this past week got a list from one carrier that, as clients in Washington are facing renewal, this is significant. And as we look at the book of business that we have with this one particular carrier, we've got a client that has close to an 800 credit score. Their policy package is going up about $2,000 a year, simply from that one factor: no accidents, no tickets, no homeowners claims. I've got another client with the same company, close to a 575 credit score. Three claims in the past 2 years, and their rate is dropping $700 a year. So it is a significant factor. You're going to hear a lot more about it. It's definitely going to be an impact, and it's going to be very noticeable for a lot of folks, but particularly those folks that have really managed their finances well. Unfortunately, it has the adverse effect that we want to see.
Thank you. Appreciate it. Okay, and I'll let you guys know if I have any questions come in after the fact, and keep in touch and make sure I share your guys' contact info with everyone as well. So if they want to reach directly out to you, they have that ability. So thank you again. Everyone enjoy these hot summer days. Hopefully everyone can get by some water somewhere and enjoy. We'll see you guys next month.
All right. Thanks, Em.
Thanks, everyone.
Bye-bye.